Alrighty. So in today's video, I'm going to be sharing with you a strategy that you can use to generate, pretty safe monthly income. Right? So what is this strategy? So this strategy basically is a way for you to accumulate any underlying that you want, so any stock that you want to own, and also generate, some premium along the way, right? Some monthly income. So as you can see down here, this is Google. So I've already accumulated, quite a number of shares of Google, and, I do use this strategy as well as a few other strategies to generally accumulate some of the shares. So I want to share with you, what is this strategy? So for you to accumulate any shares, one of the main component of this strategy is to use what is called the cash secured put, right? Basically is to sell puts on the underlying. So if you want to generate, pretty consistent monthly income, all you got to do is to sell, the put, and then receive the premium, and then just wait and see, if the put options actually get assigned or not. If it doesn't get assigned, all you've got to do is just put it on again. Now, for this strategy, we aren't just going to only sell the put, right? So we're going to add another strategy together, right, to combine this together. So it makes it a little bit much safer, just in case, if the market does come down, we're going to get, a little bit of a compensation if the market comes down, in a sense of a second form of strategy. So I'm just going to share with you what this strategy is. So first of all, let's take a look at the DTE selection, right? So before we enter into any option trade, we need to face the decision of, which DTE to actually choose. So because this strategy is to actually own the underlying, I'm not too particular in the sense, which DTE you want to choose. So again, I mentioned this in a few of my videos. If you have been a follower of my, channel for quite some time now, then you know that I generally like to go for the 45 days and above, right? The 45 DTE and above, mainly because there's an edge. And the main reason we want to do that is to avoid assignment, right? But for this strategy, we actually want to get assigned. So if you want to get a consistent monthly income, right, to get some premium every single month, then what you want to go for is somewhere around this 30 days mark, right? So you can go anything less than that, definitely for sure. Let's say, for example, if you want something that is weekly, all you got to do is just click the weekly option and just put on this strategy, right? But for this video, let's focus on the monthly one, right? Because again, there's always some trade-off, right? Some people ask, is weekly better? Is monthly better? The trade-off just comes down, in the return and the overall premium. If you go for a longer DTE, so let me just give you a very quick comparison. If you go for the longer DTE one, you notice that the absolute premium, that means the actual dollar amount that you receive, is going to be higher than if you go for the weekly ones, right? This is just common sense, right? $1.55, whereas this one is $3.15. But the difference right now is that for the weekly, you actually get, a higher return, right? Because you get this much premium. Let's say, for example, it's $1.55 only in 7 days, right? But then for the 27 days DTE, right, you can see that you get $3.15, but you need to wait 27 days for you to, really have this full premium realized to you. So if you were to just sell this 2 times, right, for example, you put this on this week, next week, once, let's say, for example, you get assigned or it expires, you sell another one again, you're going to get roughly $3.10 already. So in just 2 weeks, right, 14 days, you're going to get roughly about the same premium as you have here, right? This is for 27 days, right? So this really comes down to you, which one you prefer. So it's always just a trade-off, because let's say, for example, you only have enough to just buy 100 shares. Then if you were to sell this option down here and you were to get assigned, all you're going to get is only $1.55. But if you had this one instead, you sold this one, you would get $3.15 before you get assigned. So you will get generally more. All right, so now let's get into the actual strategy. So let me just close up this DTE down here. So for this DTE, first of all, we are going to go to the put side, right? This put section, and then we're going to choose our put option, right? We're going to sell our put. So what is this put that we generally want to do? Now, there are 2 ways to go about this. The first way is there is already a price that you have in mind. So let's say, for example, you have already decided that, hey, at 133, this is where you would like to go long on the underlying, right? So all you got to do is you just select this 133 strike price. So if the market goes below this 133, right, at expiration, you're going to get assigned. So this is the first way. Now, the second way is to go by delta, right? So you can go from anywhere from around say 16 delta, which is where the expected move is, all the way up, right? So it really depends on what you want. So the higher chance of you getting a sign, of course, will be closer to where the current market price is. This is what we call at the money, right? At the money strike price. So at the money is 137. So you definitely get more premium, but the chances of the market going below this price is going to be higher. So when we are selecting the strike price, we also want to be a little bit strategic, right? Because at the same time, we want to get the premium as much as possible. We want to keep selling this option. That means ideally we want it to expire so we can sell it again. But on the other hand, we also do want to get long the underlying, right? We want to get the shares because there's an opportunity whereby once we're long the shares, the market can go up and then we can participate in the capital gains. So one of the things that I had experienced before would be to sell a strike price. So let's say, for example, I sold the 130 only to find out that the market actually did not, go below this price, right? It went somewhere around there and then it go all the way up, right? And then, yes, I received a premium, but then if I had been assigned, I would have actually gotten much more because the capital gains from the stock itself will be much higher. So you need to have a fine balance between these two. So how do you have this fine balance? So generally, I would say somewhere around 30 deltas or maybe 20 deltas would be a nice place, right? That means to say it's going to have either a 20 to 30% chance you're going to be assigned at expiration. So in this case, let us just use the example of somewhere around 131 or maybe 132. So 132 is around 26 deltas. So this is where we have now identified our cash secured put, our short put option. Now, the next one is where we're going to use part of this premium to buy a little bit of insurance, right? Let's say, for example, the market comes down. Now, we already know that we do not mind actually getting long the underlying shares, but it doesn't hurt to get a little bit more out of it when we do get assigned, right? So how do we do that? So the way to do this is to actually also put on another strategy that is called the bear put strategy, right? The bear put spread, which is a bearish strategy. So how we are going to do this is by using part of this premium to purchase this debit spread, right? So the bear put spread is a debit spread. So as you can see down here, our premium that we're going to receive is $1.44. So from here, we want to use part of it. So let's say we use at most, we want to use somewhere around half, right? We're trying to gauge around half. So what we can do is we can purchase this put debit spread down here and see how much credit we left with. So as you can see, we left with $1 credit, which means to say that this whole purchase down here is about $44 thereabouts, right? So how do we know exactly, what's the kind of profit that we can get? Now, if you were to take a look at the P&L graph down here, so let me just go all the way to the bottom. So you can see down here, this is the P&L graph. So what it means is that if the market actually goes down below your put debit spread, you have an opportunity to actually take profits on that debit spread, right? So if the market goes down, you're going to take a profit on that. So with this strategy, because first of all, this is not a cash settled index options, that means to say you can get assigned, right? So any short options that is in the money before expiration, the buyer of that put option always have the chance to just exercise it before expiration. So if they are going to exercise it, you're going to be long 100 shares. Now, the thing is that when you put on this put debit spread, now you're going to have two short puts, right? We know the short put down here, we want to get assigned, but we do not want to get assigned on the second short put, which is part of this put debit spread. So how do we reduce the chances of getting assigned there? So basically, this is what we got to do. By the way, if you like this video so far, please subscribe and also click the thumbs up button. And also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Right, so we've already got the put debit spread in place. We have the short put in place. So what we're waiting for is for the market to actually trade down. So once the market actually trades down, it's good for our put debit spread. At the same time, we also do want to get long the underlying shares to get assigned. But first, we want to manage our put debit spread. So the way we want to do that is that once the market actually goes below your put debit spread, you can choose to take profit on the debit spread. That means to say you will close out the put debit spread first. Now, how much profit before you actually close out this put debit spread? Now, you can take it off at any amount that you want. but generally I would say somewhere around 80 to 90% would be pretty good. So if you see that you have gained, close to that max profit of this put debit spread, you can close out the trade. Now, once you close out the trade, what you're going to be left with is your short put, right? So let me just remove this put debit spread first. So now you're going to be left with this short put. Now, at this point in time, two things can happen, right? The market can continue to go lower, and then it expires at expiration, which is what you want, right? Because you want to get a sign on the shares, you want to accumulate your shares, right? As you can see, this is how I accumulated my shares for this stock. So once it goes down below that, that's good, right? We accumulate it. Now, the other thing that can actually happen is that the market, once it goes down, you've already taken profit on your put debit spread, the market actually bounce back up. So what happens then? So remember, you've already taken profit on your put debit spread. So now you're left with the short put. So what happens to the short put as the market goes up? Well, your short put will make on it as well. So that means to say, let's say if the market goes up and expires above your short put strike at expiration, then you're going to make profits on both the strategies, right? The put debit spread, remember, as it goes down somewhere around max profit, you close it out. And then now you're left with the short put. And then once it's close to expiration, let's say the market goes up and it expires out of the money, you get the full premium on the short put as well. So this way you get some kind of a double income, double the profits that you can receive compared to just having the short put. Now, what if the market actually goes up above your put debit spread after you put on, this strategy? So let me just simulate this whole strategy again. So let me just go up and put on this put debit spread, which we have. So this is the put debit spread which we chosen earlier on. So let me just remove this drawing. So what if the market just trades up from this point on? Well, in this case, your put debit spread will expire worthless along with your short put. So that means to say you're going to receive the premium, right, of this amount, which is roughly around $100. So as you can see down here, we have used part of it to actually purchase this put debit spread as a hedge. But if it doesn't go down, it goes up, then hey, at least we still realize some of the premium which we sold using the short put, right? Now, this strategy is actually pretty flexible because we can manipulate the strikes down here to get the desired kind of structure we want. So let's say, for example, you want to be a little bit more defensive, right? You want to try and collect a little more if the market comes down, right? So in this case, you will want to use slightly more of this premium to purchase a bigger width debit spread down here. So maybe instead of 1 point wide, you could go for 2 points wide. Now you notice if you go for 2 points wide, what you'll be left with is 61 cents in terms of credit. So overall, you're still going to get a credit. So now let us take a look at the P&L graph. So if you take a look at the P&L graph, so same thing, if the market goes above this whole structure, once you put it on, expires out of the money, then you're just going to get the minimum, which is the credit which you receive. Now, if the market comes down, as you can see, the max you can get is about $261. That means you get the max profit from the put debit spread, also the max profit from the short put, right? In the event whereby the short put also expires worthless. So this way, again, two different strategies you have going on. So same thing, if the market goes down below your put debit spread, and let's say you see that the P&L is something that you like, right? Maybe it's 50%, maybe it's 70%, maybe it's 90%, right? At this point, this is where you want to close out that put debit spread, take the profit, right? Secure that profit first. Now we are left with the short put again, right? So let me just remove this put debit spread again. So now with this short put, all you got to do right now, you can just leave it and see where it actually lands at expiration. Now, if you're a little bit more advanced, here's what you can additionally do. So let's say, for example, the market goes further down. So let me just remove this drawing. So let's say the market goes further down and it's close to expiration. And if it's close to expiration and you're not assigned yet, one thing you could do is to actually roll this put out, right? You already have this put option down here. What you can do is to roll out to the next expiration date or a further expiration date, and then roll the strike down as well. So what happens right now is that this strike price, instead of 132, you can roll it down. Maybe you can roll it to 130. And then with this, not only do you get, some premium, right? Depending on how far out you roll, also how far down that you roll, right? The more further out of the money you roll to, it's going to have lesser premium overall, but you're still going to get some premium if you manage it that way. So if you get some premium, you're going to at least get a lower strike price entry if you're going to get assigned, right? So if you roll to 130, market continues to go down again. And guess what? So instead of getting assigned at 132, now you're going to get assigned at 130, which is even better because right now you're going to have a lower entry price for your stock, right? Lower entry price for your stock, which means to say if the market goes up, you can, profit on this in terms of the capital gains. Now, the other thing that can happen is that once you have rolled it down, then the market shoots back up again. Then guess what? It's pretty much like the same scenario earlier on. You already taken profit on your put debit spread, left your short put, this rolled short put also now expires out of the money at expiration. All you got to do, put on this strategy over again. All right, so I hope you found this video helpful, and if you have, I greatly appreciate if you give me a thumbs up on this video. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. All right, I will see you in the next video.